Okay, welcome everyone to session 2 of our Masterclass Venture Investing for Angels. Today, we're going to help give you all some perspective with a module I call Venture Math, right? So we're going to be talking about basically hard numbers in venture and just to help you calibrate on expectations and what you're seeing out in the market, okay? Now, I'm going to drop a message into chat. And this is in case we're not yet connected and you want to find me on LinkedIn. I have a post up around this particular webinar series. If you can do me a favor to hit a like and leave a comment on there, that would be super helpful. And finally, I'll also include a link in case you want to invite a friend to this masterclass series. So that is in chat. Let's get started. This is the second part of our three-part series. Last week, we covered angel investing first principles. Today, we'll be talking about venture math. And then next week on August 6th, we will be covering due diligence and decision-making. Okay? Our agenda for today, we are going to talk about the state of venture. What do venture markets actually look like today? And that's going to give us a very nice segue into benchmarking, which is to say, what does dilution, valuation multiples, and dilution look like today? And then I want to cover another topic called startup variance. The reason for this is that we actually, it's very hard to say what is an average startup because the range is so big. And so I want to just give you some perspective again and to talk about some of these differences so that you're aware of it. And then finally, we'll just do our usual closing, and I'll be happy to do some Q&A and to share questions, answer any questions and things like that. Okay, so let's get started. Very quickly, in case it's the first time that we're meeting and we haven't spoken before, which is very realistically the case, right? Because I think for this webinar series, right now we have over 150 people registered from all around the world. So I'm really overwhelmed and honored with all the interest. My name is Jed Ng. As a tech operator, I formerly built and ran the world's largest API marketplace. And this startup was backed by Andreessen Horowitz. In 2016, I started venture investing as an angel. So I'm completely self-taught. I've never worked in VC. At this point in my career, I've got an exit and I've backed 2 companies from seed stage that have turned unicorn. And in 2020, I started building my own angel network to do syndicated deals. Basically, what I do is I go out and find companies. I do a lot of diligence because it's my kind of fun. And I share that with my network. And if they want to invest, we set up an investment vehicle so that they can participate. And my latest venture with AngelSchool.vc is we think of ourselves as an accelerator. The same way there are accelerators for startups and founders, we see ourselves as an accelerator for angel investors. And we want to help you with your first check when you're getting started, all the way to leading syndicates as super angels. So that's my mission and contribution to the venture ecosystem. As usual, we're going to start out with session terminology because there's a lot of jargon in venture. So I like to be clear about what we're talking about with every session and to just define this for all of you. So some of the terms that we might touch on today, just so you're familiar. The first one is valuation, and this one will be quite intuitive. Think of this as the market capitalization of a company, but for a private company, not a public one. And so there are processes and methodologies for determining the fair value of a startup. And whatever number we arrive at, that is the valuation of a company. Now, when we talk about valuation, you have to distinguish between pre-money valuation and post-money valuation. Okay, so pre-money valuation, as the name might suggest, is very simply what is a company's valuation just before they receive a cash investment. So if a company has a valuation of $10 million today, they have a $10 million pre-money valuation before they receive new capital. And after they receive that $1 million of investment, they get a post-money valuation of $11 million. Okay, so to recap, startup that's valued at $10 million today, after receiving $1 million, they get valued $10 million pre-money, $11 million post-money. So that's what the difference is. The point is here, if you ever hear the term valuation, make sure to be clear, are we talking about pre-money or post-money? Next, the next term is a step-up multiple. You can think of this very simply as the valuation increase of a startup in between rounds. So if you have a company that is valued at $10 million at seed stage, and at the Series A, they receive a $30 million valuation, very simply, you can say the company has a 3x step-up multiple. The next term is dilution. What happens when companies raise additional rounds of funding is they issue new shares to new investors. So the total share count goes up, which means that every single investor has a smaller percentage of shares. This is the effect of dilution, right? So my definition of dilution is when a company raises new capital, there is a reduction in share ownership in percentage terms, not in share count. So when you look at percentage terms, the percentage ownership decreases because the company issued new shares, and that basically is dilution. The next term is mark on invested capital, or MOIC, M-O-I-C. And think of this as very simply ROI, right? It's the same as an ROI definition in classical finance. So if you think about a company receiving a particular valuation in one round, and then they have a step-up multiple, they might go 3x. After dilution, let's say dilution is 10%, the resulting effect of the uplift, that is the mark on invested capital. The very simple way to think about MOIC is simply like, think of it as an ROI, right? Same like you make any investment, how much money that you put in, how much money do you get out? That multiple is the same, that ROI is the same as MOIC. Next, when companies raise new funding, they can do it in a couple of ways. One is an equity financing. So if you hear the term equity financing or price round, what happens here is the company is actually issuing new shares to new investors, okay, at some agreed valuation. So if you hear equity financing or price round, that's what it means. A company is issuing new shares to new investors at a new price. On the other hand, you might hear something called a convertible financing. And this is more relevant for all of you as angel investors, because a convertible financing is basically financing into a company based on a convertible instrument. A convertible instrument basically is more like debt, and it's not equity. So when you invest as an angel into a company via a convertible instrument, you are getting, what happens is that this convertible changes into equity at a later round, right? When a qualified financing happens. So when you hear a convertible financing, it's different from an equity financing. So that's the difference. Equity financing or price rounds is one group. And when you hear convertible financing, it's another type of financing. Another term, bear with me, I know there's a lot of these, is a SAFE. SAFE stands for Simple Agreement for Future Equity, and this is very simply a form of convertible financing. So if you hear convertible notes, SAFEs, all of these are convertible financing instruments. And the last one is a cap table. So a cap table is short form for capitalization table. This effectively is showing the share ownership of a company, right? Who owns what of a company? What's important here when you look at a capitalization table is to make sure that you are getting the right version of capitalization table from the company. Why is this? The cap table the actual cap table is going to show actual investors, so people who hold equity or shares in the company. Now, the company could have raised a lot of financing through convertible instruments, but because these instruments have not converted into equity, they don't show up on the cap table, which means that if you are looking at a company's cap table to understand the ownership structure, you need to make sure to ask for the right version. You need to ask for something called a fully diluted version, because that will reflect the share ownership when all of the convertible instruments turn into equity. All right, so that's a lot of things. This is all the terminology for today. If it's not clear, please leave a question in the chat or hold it with you. And towards the end of the session, we can open it up for Q&A. Okay. The first thing I want to start with is to talk about the state of venture today. The reason this is important is because you need to understand what venture markets look like today to have the right degree of perspective. And looking at this in the current time is really important because we're going through something called a funding winter. This is a period in venture that started towards the end of 2021, and we're going through this still today, almost 3 years later. It's very significant for the venture ecosystem because we're seeing the first major valuation reset in venture for about 15 years. Okay, so it's quite overdue in my opinion, and frankly, it's good for the ecosystem. And from where I sit, my belief is that if you are a believer in investing in venture, there is no better time to invest because the leverage and the power has shifted to investors in a very big way today that didn't exist before. So with that, let's look at some data. Now, all of this data that I'm going to show you, it comes from a company called Carta. They are a fund administrator and a cap table solution in the US. So the data that they have is very US centric. It reflects a lot of companies on the East Coast and West Coast, which means to say that this data is a little bit skewed towards outliers. And so if you are in different parts of the world, chances are this is going to look higher than reality, right? So it's going to be lower than the average for the US is going to be lower than what we see here. And if you are in a more nascent or emerging venture ecosystem, chances are that the valuations are going to be even lower. So with all of those caveats, let me explain what the markets look like to help you calibrate. What we are looking at here is quarter by quarter from Q1 of 2020 up to Q2 of 2023. And this shows median pre-money valuations for different stages. On the left here, you have seed stage companies, and on the right, Series A. When you look at this data, what are our takeaways? It tells us that at seed stage, the valuation peak was in Q2 or Q3 of 2022. And as of Q2 2023, which is the last update of this chart, we saw a 10% decline in median valuations to $13 million. And if you look at the data today, right? So basically about 1 year later, the markets for me look exactly the same, right? So we've been trending flat for roughly the past year. So it's not that the outlook hasn't changed for me. If you look at Series A, we saw a valuation peak in Q1 of 2022, and that was roughly $48 million. And by Q2 of 2023, we saw a 20% decline to $40 million pre-money valuation. When we look at Series B, we have a valuation peak earlier at Q1 of 2022, around 150 or 160 million. And we saw a 33% decline by Q2 of 2023. Series C peaked in Q1, 400 million. And as of Q2 2023, we saw a 15% decline. Frankly, I don't put too much stock in this bounce back, right? I actually think that this particular data could have been skewed by one or two very large deals that pulled the average up. And finally, at Series Ds, we saw peak valuation in Q3 of 2021 at $1 billion. And as of Q2 2023, there was a 65% decline down to 330 million. Series E peaked in Q2 of 2022, 1.7 billion. And as of Q2 2023, we saw a 70% decline. Okay, so there's a couple of trends here. One is that when we look at the different stages, the peak valuation for venture was happening, started around 2022, and actually for later stage companies, it started kicking in earlier. The second effect that we see is that when we go to later stage companies, Series B, C, D, and E, the declines were a lot sharper than earlier stage companies. There's a lot of reasons that I go through in actually the program that I teach. It has to do with interest rates. It has to do with institutional capital shifting their money around. Now, another look at this data looks like this. Okay, so this chart here reflects quarter by quarter the same data set, but I'm representing the changes for each quarter across each rows in percentages. And so if you look across the rows from seed stage, Series A, B, C, D, E onwards, you can see by quarter which quarters, which time periods where the valuation went up and which quarters where they went down. And if we can just look across green and red, you can see that funding winter started to hit in the second half of 2021. And it really started to get quite serious in 2022. And we see some stabilization in the second half of 2023. And the second takeaway for us is that if you compare the seed and Series A companies where the declines maxed out at roughly 10% per quarter, we see a lot more drastic changes in Series B, C, D, and E, right? You might see consecutive -10, -20, -40% declines in valuation. Another look at this is we can compare the peak up round multiples versus a different time period. And so what we did was we looked at data from seed to Series A to B, B to C, C to D. And we can compare the peak up round multiple against a time period. And we chose Q4 of 2022 to look at the decline. So you can see here that from seed to Series A, the peak up round multiple was 3.7x from seed to Series A, and that happened in Q1 of 2021. By Q4 of 2022, the up round multiple for C to A went down to 2.8x. And similarly, we see a decline from A to B, B to C, C to D. So takeaway here is that valuation multiple increases have declined across all stages, and very clearly, the later stages are much more severely impacted. And not only that, the time between stages is also increasing. So looking from 2020 up to Q3 of 2023, we see that Series A's took 14% longer to mature. So seed stage companies took 787 days to reach Series A versus 700 days in 2020. And from A to B, we saw a 7% increase from 760 to 844 days. And finally, for Series B to C, we saw a 57% increase. So the time to progress from rounds also got much more extended at later stages, right? So clearly there's a big difference between what's happening at C to Series A and what's happening at B to C onwards. So with all of that, I know it sounded like a lot of bad news, but in a way, it is good news to be an investor at this time. This is all of our data that we just looked at. Okay. And if I zero in on this data set, I would basically build our benchmarks for pre-money valuations based on what we're seeing here, right? In Q1, Q2 of 2023, I think some of the later stage data is actually artificially depressed. So I'm willing to have a higher number at series, maybe C, D, and E. As a broad average, what we are assuming now when we look at median US companies will look like this. A pre-seed company should receive a pre-money valuation of $6 million. Seed stage companies should be at 13 million. Series A, we would price it at $40 million. Series B at 100. Series C, we'll put it at 250. And Series D and E, we go up to 600 and $1 billion. So now let's work on filling in the rest of these gaps. We immediately know how to fill up the step up multiple, right? Because when we go from pre-seed to seed stage, for example, the step up multiple, you can calculate it's 2.2, which means that we can fill in the second row. And then the last piece of the puzzle is going to be dilution. And that gives us a view towards the MOIC. So let's solve dilution first. This table here is a rough chart showing share ownership it shows founder ownership or founder equity across different stage of companies. So you can use this as a rough guideline. And the way to read this is that the ideal case at, let's say, seed stage is that founders should own 60 to 70% of the company still at seed stage. And if they have 50 to 60%, it's still okay. But whenever at seed stage, you see a company where the founders own 40% or less, this is what's called a tricky or broken cap table. So if you ever hear that term, a broken cap table, this is what it means. It basically says that the founders own too little shares of the company. So why is this the problem? There's a few reasons for this. One is that as the company progresses from C to series A, B, C, etc., they're going to keep raising more money, which means that they give away more of the company to new investors. And so the founders own less and less, and so do other investors. The concern here when founders own too little at the early stage is that as they get further along, they own so little of the company that they basically don't have an incentive to act in the best interest because their upside is simply too small. And this is why you as an investor, when you invest, you want to understand what the founder ownership is, because if it's too little at the early stage, it's going to be problematic. Either the founders, they own too little later on, and so they might not act in your best interest. Or another implication of the founders owning too little is that future investors might look at the ownership and they'll go, hey, you know what? This scares me too much. I'm not willing to invest in that company. And so it actually diminishes the chances of the company raising on following on funding, right? So there's some very real implications for you, which is why you need to pay attention to this. Now, so this gives us rough guidelines on founder ownership at different stages. And when it comes to dilution, we tend not to see big fluctuations in dilution. There is some variability, but whether it's a down market or up market, founder dilution, dilution doesn't tend to change a lot. The reason is that we see a very clear pattern in capital availability and valuation, right? Which is a very simple way to say that when there is more money flowing into the ecosystem, companies will raise more money and they will also increase their valuation. It very much comes down to supply demand, right? It's a very primary driver in my view. And so because of that effect, whether it's an up market or down market, dilution tends to stay within a relatively controlled band. And here's the data behind it. So what you're looking at here is seed stage companies. On the left is the median amount of cash raised quarter by quarter from 2020 up to Q2 of 2023. And on the right is median pre-money valuation. And the point here is that you see a very clear pattern in when companies raise more cash, their median pre-money valuation also increases, right? So this is what I'm talking about. When companies have more cash, they raise a higher valuation, and therefore the dilution tends to stay in a narrow band. And it's not just at an early stage, because we see the same pattern at Series A. So this is the pattern at Series A. We see it at Series B. And if you look at Series C, D, E, it's the exact same pattern, right? So this is like why I say this. So let's look at all of this, and based on this data, we can basically give dilution benchmarks. The benchmarks that we are relying on looks like this. We're saying that when companies go from pre-seed to seed, on average, they will be selling 21% of the company to new investors. So that's 21% dilution. And at Series A, we have 20% dilution. Series B, we have 17%. Series C, 13%. And then at the later stages, it drops down to 10% and 10% at Series D and E. So now we can start to put together this table to get a full view of what venture benchmarks look like today. We're saying that at pre-seed, median pre-money valuation, 6 million. So you invested at pre-seed, and let's say you could sell at pre-seed, you would get a 1x MOIC, right? Whatever you invested. If there was a buyer and you got full price, you get your original money back. So your ROI or MOIC is 1x. When you go from pre-seed to seed stage, we see a 2.2x step-up multiple to $13 million pre-money valuation. And after you dilute that return by 21%, we get a 1.74x ROI or MOIC, which means that if you invested at a pre-seed stage, and if you could sell your holdings at seed stage on this median or average company, you would get a 1.74x return. At Series A, we get up to $40 million pre-money valuation, and that comes from a 3x step-up multiple. And after 20% dilution, your MOIC goes to 2.4x. Series B, we get up to 100 million valuation, and after 17% dilution, we have 2.08x MOIC. Series C, $250 million valuation, we get 2.18x. Series D, we see another 2.16x MOIC, and Series E, a 1.44x MOIC. Okay, so high-level averages, this gives you an idea of what to expect across different rounds. Now, another way to put this data together is in the form of a matrix, right, or a table. And here we are just taking that same data and to compute the MOIC. If you think about each of these rows at the entry stages, so if the first row here is if I invested in pre-seed and I exited at seed stage, Series A, B, C, D, E, invested at seed stage and exited at A, B, C, and so on and so forth. Okay, I put this together because we want to show you the effect of compounding MOIC, which is what happens when you invest in a particular stage and you hold on across multiple rounds. You get maybe 1.5x MOIC here, 2x MOIC there, and those numbers seem small, but when you hold it across multiple rounds, there's a compounding effect, right? Because you multiply all of those numbers. And so the way to read this chart looks like this. The data says that if you invested into a seed stage company and you held on to this company up to Series E, and this was a very average or median company, if you could liquidate at Series E, you would get a 33x% return on your investment. Okay, so the point here is to like illustrate that by holding your investment across multiple rounds, that compounding effect actually starts to stack up. And this is where you start to see large numbers. So the earlier that you invest, that compounding effect should grow, right? And so this is kind of like the compensation for angel investors for investing at an earlier stage, for taking on that additional risk. So while all of this data represents an average, we also want to we also want to like look at variance. Okay, so if you look at across different startups, what does average look like? And it turns out that actually it's very hard to find a definition of average because there's such a big variance. And even small differences in performance, in valuation, in dilution actually make very, very big differences in return. So that's the point I want to illustrate in this next section where we talk about variance in startup. So I'm going to start here. This data, again from Carta, so it's kind of representative of US companies. What we're looking at here is dilution distribution across different stages, from seed stage to series A, B, C, D, etc. And so here at seed stage, this is kind of like what guides our dilution benchmarks, right? Because the median seed stage company has 20% dilution. But if you look at the distribution on the right here across these bubbles, you see that if we're looking between a range of 10% and 30% dilution, okay? So remember, the average is 20. If we enlarge that span to 10 to 30, there's actually a huge range here because 74% of companies fall within that 10 to 30% band. If you look at Series A, again, between 10 and 30%, with 20 being the average, we see 70% of companies falling in this range. And at Series B, with a median of 17%, and looking at a range of 5 to 25, we see 70% of companies. And similarly at Series C and Series D, right? So my point is, even though that there is a median or an average, there's actually a very wide degree of variance on dilution, and this can have a very big impact on your returns. Another source of returns, another source of variance comes from startup performance. And to make this point, I'm going to show you data from a venture capital fund called Bessemer. They are famously a cloud and software investor, and they analyze their portfolio and to benchmark performance across different metrics. And this particular chart shows growth. And so this is kind of their benchmark of what good looks like in software. So it's a way to like kind of guide our thinking, right? But if you're investing in other sectors, maybe you have to calibrate the benchmarks a little bit more differently. And if you look at different companies, right, we're just going to focus on the left for companies which are between 1 million and 10 million ARR, annual recurring revenue. The data says that actually, if a company is growing 230% year over year, this is a top quartile, top 25% in performance. And if a company is growing 100x year on year, basically doubling year on year, you're actually bottom quartile, which is why when I see a software company, and the benefit of a software company is that your distribution and scaling is quite cheap compared to other business models. And we see a company only doubling year on year, is actually not that interesting. We want to see more than that. But the point I'm making for you here is that between top and bottom quartile, this 100% growth year on year versus 230% growth, it's a huge range of companies. Another one is looking at, I believe this is unit economics, which is gross margins. And again, this is from Bessemer, and they're saying that, hey, a top quartile company has 85% gross margin. So whatever you sell at your licenses, you should be getting 80% gross profit. And so that generates cash for you to pay off your bottom line and to get you down to EBITDA. And a company that's doing 65% margins, that's actually bottom quartile performance. So these are a few examples of data that talk about variability in startups. And I want to bring us back to this matrix. The numbers here look very different. And what we're simulating here is the same matrix or chart as before, but we're saying, what if you could invest in a company and you are picking a company that does 10% better across every stage? I'm not talking about multiples better, just 10% difference. And that 10% difference can come from your growth rates. It can come from your margins. It can come from how much your business model and how much dilution that you take in. And so if you look at this, taking the same example of seed to Series E, where the median company, if you invested at seed stage and held to Series E, you would have generated a 33x return. In this case, if we could pick a company that does 10% better than average across all of these different stages, you actually end up with a 54x return instead of 33x. So my point here is that, number one, there is averages. Number two, there is a lot of variance in startup performance. And so you want to pick companies that do above average. And even small differences in being above average can translate to very big returns for you as investors. And so this is why we pay so much attention to our due diligence process, the company's metrics, and all of these things, because we want to find above average companies and ideally top quartile performing companies. So with all of that, I want to start to wrap up and to talk about how we approach things as our strategy on being better investors, just sharing how we think about having more impact and also picking better companies. And I finish this section, we can open up with questions. I saw a bunch of things in the chat already. I talked about this before, but very quickly, just to recap, the way we want to do our programs and our philosophy of working with investors in the community is not to be like a typical education institution where we teach you something and then we just leave you out to the wind to go figure things out. We want to be part of your journey. And so we start your journey off with our programs. We have a venture fundamentals program for people who are newer to venture and just starting out. And this is just to give all of you essential venture skills in just 10 hours. Basically, I created this program with the idea that if I could rewind time 8 years and to tell Jed 8 years ago, before you start investing, spend 10 hours with me, and I'm going to give you all the knowledge I wish I had. Okay, so that was the idea behind it. And our other program is called the Syndicate Blueprint. And this is for you that are a bit further along in your journey. You want to run your own angel network. You want to be able to write six-figure checks through an investor network. You want to earn carried interest. This is the program for you, right? I teach it. It's exactly how I run my own syndicate, which we've grown to 1,300 investors. Now, after you finish the programs, what we do is we invite all of you to be part of our investment committee because we want you to have a forum to practice your skills. So you learn something, and by being part of our investment committee, you get hands-on deal experience, you build your track record while having a safety net. And as part of the investment committee, we also have a carry sharing program. So it entitles you to earn upside on every single deal that we do. And by the way, you have zero expectations to invest as part of the investment committee. This is mainly a forum to learn. And finally, when you're ready and you're ready to invest on your own, you can do that. Or for those of you who are further along, you can launch your own syndicate. So this is our philosophy of 1, 2, and 3. This is our approach of how we work with the investor community and to give value to all of you. But this is also part of our strategy. Because if you think about venture bottlenecks, and it doesn't matter if you're an angel investor, you're a syndicate lead by like myself, or even a VC fund, everybody has a bottleneck. Okay, the bottleneck is actually human capital. The challenge of scaling up what we do is actually human capital related, which basically means that if you want to invest and see a lot of companies and have access, this is a problem not of technology, but of networks and relationships. It is about having time and energy to scale up your diligence because there is no technology that is going to do diligence for you out of the box. It's the state of the art. It's investors practicing their skill. And it's also about scaling up your expertise, right? Because every company operating in different parts of the world is going to look very different. And so if I'm in Asia or if I know how to invest in software companies into the US, how do I evaluate companies in Europe or in Asia, for example? That's the problem that we want to solve. And so our strategy is to actually use our learning philosophy, right? How we give value to our community by teaching all of you through our programs. And after that, inviting you to our investment committee. And this is a way for you to get deal experience and build community and build networks and to do all of these great things. And so this version of Angel School for me, the strategy that we're executing really looks like this. What we're actually building is infrastructure because we have today 3 investment committees, one in the US, one in Europe, and one in Asia. And we have these autonomous distributed deal teams operating around the world. At any one time, we are doing diligence on 5, 7 different companies at the same time. And collectively, I think we are making better decisions together. So I'm just sharing with you because, besides the knowledge that we're giving back, we're also constructing all of this to also elevate our ability as investors and to get every advantage that we have. So with that, I'll start to end the session here and to open up for all of you for questions. Feel free to turn on your microphone and your camera and to ask. I did want to share very quickly that our venture fundamentals program, this is available as an online format. And my next program is in middle of September. So if any of you are interested, feel free to reach out and we can talk about it. I'm happy to share more information. And for those of you specifically in Singapore, I am running a live boot camp at the end of August. So August 24th to 25th, we are going to do a live boot camp at the INSEAD campus in Singapore. So it's going to be a long weekend, not a long weekend, a day and a half boot camp, a live session. I'll be teaching it and it'll be a live session. So it'll be a lot more interactive. If you are interested in this, feel free to reach out. Looking forward to seeing you there. So with that, I'm going to conclude today's session and open it up for questions. So who's going to kick us off?
Thank you, Jed. I got 2 questions in there for
Hey,
you.
Dominic.
Yeah.
Yes, please.
I'm just curious, when is the company ready to go from A to B to C to D and E? So what are the basis of deciding that they are ready to move or raise more fund, in other words?
Yeah. I would say, Dominic, there is like no real strict definition. It does vary from sector and geography. Roughly speaking, the benchmark for a company to go from seed stage to Series A is you have a product in market, you are monetizing, and classically people would say, $1 million ARR. That tends to be where companies start getting into Series A fundings. Okay, although with the funding winter and like capital being more scarce, we've seen like that threshold actually go up, right? So it might be closer to $2 to $3 million ARR before a Series A. So the bar has like gone up. And at the same time, the valuations are coming down, right? So from an investor point of view, this is why I say I think that it's actually a good time to be an investor because you're getting deals where they have more revenue, valuations are lower, so it's cheaper, right? And it's safer as well. But yeah, that's what I look for when we play, seed to Series A, that $1 million plus ARR. We like that, right? Because a lot of the company has de-risk. And roughly speaking, you probably need $3 to $5 million ARR to be Series B, and then 10 million to like get Series D. Yeah, it's those are some high level numbers.
Right. So it's more in terms of their revenue growth and not that they are running out of money.
Well, running out of money is a problem also. And of course, the founders will try to like massage the optics, right? Which is why you need to be a savvy investor when you do diligence and to understand why they raising money. Is it because they've hit the revenue targets, or are they running out of money, which isn't necessarily a bad problem? It's more like, if you invest now, will they continue to grow, right? Or are they just going to burn? I would say that for looking at the companies that we do now, uh, because of because of uh, because of the climate, our assumption is that for the next year, capital is going to be scarce. So the companies that we look at, I'm going to make sure that it's a well-capitalized round, that you have enough runway for at least 12 or 18 months. Ideally, based on your growth trajectory, I have some degree of confidence that during this time period, you will be able to be profitable and self-sustaining, right? So this is us mitigating risk.
Mm, mm. So if you invest in a company, would you use a special purpose vehicle, or would you just I guess you probably want to use a special purpose vehicle, right?
Correct. For me as a syndicate lead, when I need to aggregate that capital, we will use an SPV. We will rely on an administrator to make sure that there's KYC, legal document signing, bank account setup that's completely firewall for me, right? I don't want people transferring money to me and like handling that. Like, we don't need all that.
Yeah. So the investor will deal with you, uh, who sort of head the syndicate in the SPV,
Yes.
for all the financial information, right?
Yes.
Okay. So second question I have is that technology company,
Yes.
they basically don't have buildings, PPE, and all that. All they have is intellectual property
Correct.
assets. So how do you value a company's intellectual property assets, and how do you know that it's worth that much?
Yeah. Good question. I honestly don't have a very good answer for you. I'll tell you my thinking, which is probably more philosophical than an actual one. When I look at companies and thinking about them as an investor, what I'm looking to do is like value it based on revenue. Like, that I can count, right? And we value that, and we think it's a fair valuation. We're okay with, that price, which kind of abstracts away the need to value the IP.
Said.
When a company starts trying to get valued because of the IP, it's a very binary outcome in my view. Either it's a fire sale, you're out of money, you're trying to cash out, and you're trying to get whatever you can. Then it's like, oh, our IP is valuable, but then you have no leverage as a seller. Or it's a really good scenario where the IP truly is unique, it's so valuable. And in which case, for me, like, it should be reflected in your revenue and numbers, right? Then we kind of come back to that original position.
Okay. So actually,
Jed, can I ask a question as well?
Sure.
Can I just
Can I finish
finish
up,
I
Cynthia?
just
One
finish off
second.
with Jed. So the valuation for investors in investment basically are just looking at the potential cash flow, because we are not going to stay long. We're just going to exit at a certain point, right?
Not necessarily cash flow, right? Because a lot of these early stage companies, they're not going to be profitable, but they should be growing. You can value it based on revenue,
Revenue.
right? When we think about cash flow, for me, it's managing risk. You don't want them running out of money and can't raise more, and then the company's dead, right? Either that, or it's a fire sale and you get pennies on the dollar.
All right. Okay. Thank you. Over to
Thank
you.
you. Cynthia, sorry, we cut you off.
Oh, yeah. I thank you so much for hosting this. I've got a question regarding specifically emerging markets and if there is data on, startups, say in Africa, in any other emerging markets, specifically focus on CapEx heavy startups. I know you've mentioned a lot of the Carter data and Bessemer is specifically focused on, software. But like, is there information on, CapEx heavy startups across the emerging markets? I'd really like to get a hand on that.
Cynthia, where are you calling in from?
I'm from Nairobi, Kenya, which is
Okay,
yeah.
welcome from Nairobi. Thank you for joining. I don't have specific data. This is one of the challenges of private market data. It's very opaque. It's not transparent. Second problem is that a lot of there might not be very many data points, right? So the volume is low, and so even if you could get data, the volume might be so low it's not representative, right? Or you have not enough transactions in a time period, so the numbers might be skewed. And so the best available source, honestly, that I could come up with, and also happens to be free and public, is the Carta data. But like you said, it's very US centric. It's not really representative. I would say start there and calibrate down, right? Based on the market. The other way to calibrate is do a bottoms up by just understanding market conventions where you are. And this can be simply talking to other investors or founders like, hey, if you talk to, let's say, 5 seed stage companies and say, what valuation did you raise your company at? That's going to give you a pretty good indicator already of what the thresholds are. And maybe another effect, Cynthia, is kind of going back to, let me find this. Yeah, this data where we map out cash raised and the valuation, right? We saw this pattern where there's this hump where companies, they're raising more cash, they have a higher valuation. This basically is a function of, I mentioned this because you talk about CapEx heavy companies, right? So CapEx heavy companies, they need this cash in order for the founders not to get diluted. They're going to push for higher valuation. So this effect is going to be in play. So to put all of this together, my answer to this question is number one, top down, start with the Carta data. Bear in mind it's US centric, so wherever your market is, it's going to be a lower number. You can get a bottoms up view by just talking to a few startups or investors, look at the stage you're at to get that calibration. So then you have some kind of range. And then the third part of it, when you talk about CapEx heavy businesses, be aware, right? When the company needs to raise a lot of cash in order not to give up that much equity, which results in dilution, they will try to push the valuation up. So that is going to come in. I know it's not a very direct answer, but welcome to the crazy world of venture.
Thank you. Thank you so much. It's very clear.
Sure.
Thanks.
Hey, Jed, cool if I go next?
Hey, Masao, good to see you, man. Yeah,
Good
please.
to see you too. Thank you so much. This is really, really informative and I'm learning a lot. Two questions and I'll keep them short. The first one is, how often do angel investors hold beyond Series A, Series B? Does it happen very often or do they get bought out by that stage? And the second question is, do angel investors need to exit at a round, or is there a way to engineer your own exit along the way? Thank you.
Okay. So again, a multi-part, kind of complicated answer, Mustafa. One is that it depends how you're investing, right? So if you're investing as an angel, you tend to have less leverage on the exit, right? My general thinking is before you think about the liquidity, think about the diligence, because there's only going to be liquidity if you pick a good company and it's going to do well. Otherwise, nobody's going to buy you up, right? So focus on that as a first principle. Now, if the company is doing well, that increases the chances that you're going to get a buyout offer at Series A and B. And that one becomes philosophical. Do you want to take your money and recycle that and to build your track record and say, hey, I got an exit, I want to recycle and invest in the next batch of companies? Or do you want to ride, knowing that as you ride, you have that compounding effect, right? So you get this exponential increase in your returns. One implication of being an angel investor is that you're relatively small check on the cap table. And so there could be a situation that where the company is doing really well, Series A, Series B, the new investor comes in and they say, hey, you know what? I want more equity, and the VC might just try to like push you out. In which case, unfortunately, the reality is, I would say, don't fight it. Take your money. You made some money. You have an exit. Take the win and move on. Right. And for me, this is why the syndicate model actually makes sense, because we're writing a bigger check. We get a bit more leverage or say in these discussions. In a later round, if a VC comes in and they say, oh, we want to institute, pro rata, otherwise we're going to convert you from preferred to common, the syndicate gives us a much better chance to like maintain our pro rata. Right? So it gives us more avenues or more tools to stay in the game if we want it.
Awesome. Thank you.
Sure. Thanks for the question. Michelle, did you want to ask your question? Are you still around with us?
Yeah, I'm still here. I was wondering, I mean, actually maybe linked with what Rashid just mentioned. So if there is I mean, in the event when the founder reaches out, for example, either a syndicate or a startup studio, venture studio, or similar, then I would imagine that they would take a stake that is close to 10-20%. Would that be leading to less VCs being interested in that? I'm referring to one of the slides that you mentioned where the dilution is high enough to impact the cap table. Yeah, this one exactly. So how is that linked with the syndicate approach? When I saw that most of them would take around 20%.
Yes. So the 20% number that you hear probably comes from VCs when they get involved. They roughly want 20% ownership of the company. And that really kicks in at Series A, B, C onwards. So Series A and B, right? Roughly the VCs will want 20% stake. That's kind of like the benchmark. Anything before that, as long as the founder, let's say we're looking at this number, right? This seed stage, 60%. All we really care about when we look at the cap table is that the founders after the round should own 60%, and everybody else, all the other investors, own 40%. We are kind of like in the right ballpark, right? And bear in mind that when you're looking at this number, make sure that it's fully diluted, because a lot of more early investments as angel on those convertible
will kick in at that step. Yeah,
exactly. You get it.
And the dilution part is actually mainly for the ones that have a decision making. If I'm an angel investor at a idea pre-seed seed stage, a small ticket, I mean, small, everything is relative, but let's say 10, 20K, I actually don't care if I'm diluted because my number of shares stays the same and the money, okay, I might be kicked out later, but it's the number of shares that is important for me. The dilution is less relevant for me as a non-executive or non-decisionary. Is that correct?
No, I would disagree with that, right? So you don't care about the number of shares. You should be caring as an investor on your percentage ownership. Okay, so that's the first thing. The second thing is, depending on like this whole everything I'm going to tell you has to do with dilution. Okay, which is why we say we don't care about the number of shares, we care about percentage of shares.
But why? Like, let's say I have 1,000 shares. What's the difference for me in terms of return if I have 5% or 0.2%? I still have 1,000 shares.
So let's talk about it a different way, right? If you own 1,000 shares out of 5,000, you own 20% of the company. But if you own 1,000 shares out of 1,000,000 shares, you own 1% of the company. It's a very big difference, right? And that basically is your distribution of value, which is why you care about the percentage.
But if it's 1,000 share, it's the price share that matters to me. I'm just trying to understand. I'm not challenging what you said.
Yeah.
I'm just
Yeah.
trying to understand, because the 1,000 shares multiplied by the share price will give me the same amount of return in both cases, whatever the percentage is.
Oh.
No?
Yes, you are right. Okay. I mean, but so there's two variables in play, right? Your share count, does matter.
Mhm.
But the share count, why I say that it's the percentage that matters is like, the percentage that you own is going to say how much of the company that you get, right? When it comes to like distribution of value, you should care about dilution, because
Okay.
dilution is going to affect how much, basically what proportion of the value that you have. For me, that's what it comes down to. I think the other technical thing to be aware of is that as an investor, and this is something that we will cover in the program, Michelle,
Okay.
the type of instrument, whether it's, even if you're using convertible instruments, whether it's like a pre-money or a post-money vehicle, those things also have like technical differences on your dilution impact.
Yeah. Okay.
Yeah. We can have an offline conversation, by the way.
Yeah, with pleasure. With pleasure.
It's okay.
Jed, one more question.
Yeah, Daniel.
Following the
Thank you.
discussion you just had with Michelle. So if you are the A seed seed A series, if you have a A series, do you then have to buy more shares so that you can maintain the value of your shares?
Yeah. Okay, so what you're talking about, Dominic, is pro rata. You're not, pro rata gives you the right as an investor to maintain your ownership percentage. So not number of shares. Okay, so very simply, if you invested in a company at seed stage and you own, let's say, 1% of the company, and at Series A, the new investor buys out 20%, and so the dilution causes your 1% to go to 0.8%. If you have pro rata rights, and this is something you should secure with the company when you invest. Pro rata right says Dominic can buy another 0.2% to maintain your original 1% stake. Assuming that you could afford it, it gives you a right to maintain that. That's what pro rata means. So, and based on this, the share count falls out of that calculation.
Okay, so you'll buy at the new valuation, right?
Correct.
Okay.
Correct. Which I think is one of those other challenges of having pro rata, right? Like the better the company does, the stronger the signal that you should maintain your pro rata. It's more likely to be successful. But on the other hand, the better the company is performing, the more expensive that pro rata is also. Which is, again, I don't want to keep bringing it back to syndicates, but this is an advantage, right? Because now we're able to like keep up with it in a much better way rather than an individual angel where it just simply gets too expensive.
All right.
And question from Michael. You just registered. Michael, yes, absolutely. We will send a post session email. You will get the slides. We will include a link to the recording, both last week and this week. And so that will also be available to you.
Perfect. Thanks. I think it was me, or there's another Michael.
There's another Michael. I referred
okay,
to you
sorry.
as Michelle. To try to
Okay,
give you-
thanks. Thanks, Jed.
Okay. Happy to stay on, take a few more questions, but if we're all good, I'm happy to wrap up the session here as well. Thank you everyone for joining. As always, I know some of you it's late in Asia or you're in Europe, then it's middle of the day. So thank you for taking time for this.
Thank you.
Right? We will see you next week and looking forward to session 3. Thank you, everybody.